Alright, let's say you want to get started with this investing thing. You manage to save a couple of money, not enough to buy a house, let's say. So, how are you gonna start? You are thinking probably you wanted to invest. You heard on the news for some stocks, Tesla, Google, Apple. Like if you had invested 10 years ago, probably you would have 10 times your initial money. Some very simple questions like how on earth do you buy a stock? You go to the company site and you just click buy stocks, or you just Google how to buy the best stocks. And all this financial terminology like inflation, recession, bear market, bull market and so on. And on top of that, there is the anxiety that we all have that probably we're gonna lose our saving account because you know that investing is risky and dangerous. So this is the ultimate guide on how to start investing and things that you wish you knew before you start. And also the same advice for myself that I would give 5 or 10 years ago before starting. So what we will cover in this video is why and how to invest. So what happened to your money by default? Simple economics teach us that money loses value over time thanks to something called inflation. This is general increase in the prices of goods and services in an economy make your money loses value, and this is how it works. The prices keep increasing at a percentage level every year. Approximately the past 100 years, the average is above 3% per year. Let's give an example. Let's say that you have 10,000 USD stuck in your mattress. The same amount after 10 years will worth significantly less. You won't be able to afford buying the same products as money lose their value over time. So clearly the bad solution is not an option. Okay, you might think opening a saving account will help you from this solution. However, a saving account won't give you more than 0.2% per year. Even if the interest rates goes higher, the percentage won't be enough to compete with inflation. So what you do? Well, if it was so easy, then everyone would do it. How do we actually stop our money from losing value over time? Is there any solution on that? Let's say we have a hypothetical saving account that is able to give us more than 3% per year. So this will be our base. Above that, it means that we can keep with inflation. So actually, we do not lose money, and this is our base. We need something that is able to produce more than inflation, and keep that in mind. But of course, not only we don't want to lose money, we want to generate money, we want to invest. So here comes the main question. How do we actually make money? Let's go back to our hypothetical account, and let's say that this account is able to generate us 10% per year. We are talking hypothetically here, there is no such a thing. 10% per year considers to be a huge return. So let's go back to that account and we will deposit 1000 USD. So after a year, since we have a 10%, you will have 1100 USD. The second year, 1200, 1300 and so on. So calculating after 10 years, you will have approximately 2350 USD, which is not bad at all. I mean, you double your money. Someone might say that 10% is not enough, but keep in mind that we managed to double our account and also keep up with inflation. This would be a very good hypothetical scenario. However, in real life, there are no such accounts. Best case scenario, to find an account that will give you a compound interest close to 1%. And of course, this doesn't work. Remember what we said about inflation. You are keep losing money. For sure at lower rate, so it's much better than putting under your bed. But again, the issue remains. So what we want to achieve is to come close to this 10% nirvana thing. And this is where investment come into play. So what is an investment? An investment is something that puts money in your pocket. Let's say you buy a house for 200,000 USD. There are two ways you can make money out of it. The first way is that you can rent it. Let's say that you manage to rent your property for 2,000 per month. This means that in an entire year you will be able to get 24,000. That means that in approximately 9 years you will be able to pay it off for your entire house, and now you will start getting profits. This is the first way that you are investing. Secondly is an investment because the value of the house will keep increasing over time. At least this is what the statistics shows. Over the long term, in most countries, properties keep increasing in values. The same house you bought over time will keep increasing in value. So by buying a property, you are investing by two ways. Not only you are getting steady income every month, but you have also gains since the same house worth significantly more. Statistics shows that in most developed countries, the property value doubles every 10 years. This 10 years time, not only you manage to make 240,000 from rents, but you also hit gains from your property increased. And now the value is almost doubled. Of course, this is very hard. This is the reason that you cannot easily invest in property. You need a lot of initial capital and also you need to manage your property. So it's not so easy. So if you don't have so much money to invest and also so much time, this leads us to another way, investing in shares. For me, basically, this is the best way and my entire portfolio is consist of shares. And we are talking about the long term here. No doubt they are going up and down, but in the long term this pays off. Also a very small percentage in cryptocurrency, however they are very volatile, so I do not recommend. So what are shares and how they actually work and how you can actually get them? Buying share is the closest thing we can do in order to come closer to this hypothetical 10% account of our dreams. So this is how a share works. Every time you buy a share, actually you own a small part of the company. Since you are owning a small slice of this company, you are also eligible to take dividends. Based on the company performance, they will split some earnings to the shareholders, to people that are owning the shares. The more shares you own, the bigger slice of this pie. Let's use as an example Google and the double benefit effect from investment we described earlier. If you had invested 1000 USD 10 years ago, today you would have increased your initial investment by 10 times and you also would be a part of their profits in form of dividends. Now, of course, you don't have a time machine to go back and inform yourself to do that kind of investment.
This baby hits 88 miles per hour. You're gonna see some serious shit.
But how actually you can buy a share? I mean, you cannot just Google buy shares of Google and do it. In this case, you will need a broker. Let's say 20 years back, this broker was an actual person. You should call someone, let's say John, and inform him that you want to buy some Google shares at the given price. He would place some paper order and actually you would own shares of Google. Today things are completely different and automated. You actually just need to open a trading account and just make your own transactions through this console or through this broker. The legislation, of course, is different from country to country. Usually, most banks own their own brokers. This means that if you have a simple bank account, probably you would be able to open also a trading account through your bank. Most likely their software will be cranky, so in my case and what I strongly recommend is just use a broker that is certified and meets all the criteria. So you have a couple of money you want to invest. Obviously you cannot buy property or houses because they are too expensive. So how do you start? The first thing is that you need to open an account, and trust me, this is the easiest part. And here comes the tricky one. What shares should I buy? Should I buy from one company? Should I use many? Obviously you don't own a time machine, so you don't know exactly the performance of your investment. A very good idea and what I strongly recommend is start trading by using a demo account. All brokers provide this option and you can open a hypothetical account, of course without using any real money. And this is how you will become familiar with the process. You know how to do it, how to put a put order, a sell order, a buy order, a pending order and so on. And also getting familiar with the idea. You will be able to learn and practice without any risk because you will just open a demo account. The hot question remains, what shares should I buy? You should buy only from one company or you should diversify your portfolio because this will give you the opportunity for less risk. It's like putting several eggs in different baskets. Keeping only one share from one company increases your risk because obviously this company might not perform well. Also, you might hear some rumors that this is the best share, this is the best company, this will be the company of the future, and so on. However, investing is always risky. This is something that you have to keep in mind every time you are investing. This hypothetical Garden of Eden of 10% is not easy to get. When your portfolio is diversified and you have multiple shares and multiple companies, you won't be stressed when one of them doesn't perform well, because you know that the rest of them will do. And again, someone might ask, okay, what happens if none of my stocks perform well? Well, if you diversified your portfolio well enough, you won't have this kind of issues. The main idea that you need to understand is that you risk more by exposing yourself into one unique stock. And also, you don't know how well a company will keep performing. Previous historical data doesn't guarantee future results. That time machine from Back to the Future unfortunately is not available, so we have to keep up with what we have. So the advice that you will get from most people, at least for beginners, is to not invest in a single stock. You should invest in index funds. This is the best, safest long-term investment that you can do. But the question comes here, what exactly is an index fund? The word contains two definitions, index and fund. A fund actually is where investors like you will put their money. Multiple investors will invest in the same fund. The fund decides in which companies they will ultimately invest. Let's give an example. Let's say I own a fund called Genos. I have gathered from multiple people like you, let's say 20 millions. Then I split this amount of money and I buy 20% Apple, 25% Google, 30% oil companies and so on. So you as an investor, of course you don't have to worry, as I will make all the choices. I will manage your money. And this creates less risk as you don't have to take any decision. You will get your returns and they will keep a commission, like 1 or 2% depends. You don't pick something, you just need to trust me, you need to trust my choices. I know it's not perfect, however, as a beginner, this is the best thing you can do. Now we come to the second part, what is an index? This refers to the stock market index, like the FTSE 100, the S&P 500 and so on. A basket of stocks, as we described earlier. For example, the S&P 500 is the 500 most powerful companies. I will drop a link in the description in a separate video if you want to see the subject. If you check the performance of this index, for example, you get the idea of the entire performance of the US economy. And this is the reason that you can use the indices. As you can see in the diagram, performs really well. And I'm talking about the long term here. At this point, you have understand what is a fund and what is an index. So you can combine these two words together. It is a fund that invests in this index, in this particular index. So as a beginner, starting investing might be complicated. So investing in this kind of index funds makes things much easier. You don't take any risks on your own, you leave to the professionals to do the choices and so on. Actually, you don't know fundamentally how to invest in a company. You don't know how to read the balance sheet, you don't know from companies, you don't know from indexes, you don't know from industries. Generally speaking, you don't know how to invest and where to look. Also with indexes, you get a great amount of diversification. Historically, if you take a look at the indexes, you're probably going to see that they are performing really well. Buffett clearly said that if he had 100,000 to invest, he would invest the S&P 500. And if we see the chart, we will understand why. Again, remember what we said, historical data doesn't guarantee future performance. However, with indexes, in the long term, they look much more safe option. In 2008, Warren Buffett issued a challenge to the hedge fund industry, which in his views, they charged extraordinary fees and their performance couldn't justify them. Buffett won the bet and outperformed them, proving that investing in an index can be much more profitable in the long term. Actually, it's very hard to predict the market and also it's very risky. But still indexes remain a safe choice, at least the safest. So instead of believing that you have an amazing feeling or you can trust your instinct or whatever, better choose the safe option. I can guarantee that most of these 25 years old traders have no idea of what they are doing. They just show you fake images, fake results, and that they just try to convince you to buy from them. Either it's a robot or an automatic system or any other technique, and I strongly recommend to avoid them. There are many professionals out there with proven trading history and they know exactly what they are doing. Keep that in your mind really well before start trusting anyone, especially with your money and your savings.
So that's at least given us a flavor of that amazing mind in there.
Let's
talk about Renaissance, because you took that amazing mind and, having been a co-cracker at the NSA, you started to become a co-cracker of the financial industry. I think you probably didn't buy efficient market theory, and somehow you found a way of creating these astonishing returns over 2 decades. I think the way it's been explained to me, what's remarkable about what you did was that it wasn't just the size of the returns, it was that you took them with surprisingly low volatility and risk compared with other hedge funds. So how on earth did you do this, Jim?
Well, I did it by assembling a wonderful group of people. When I started doing trading, I had gotten a little tired of mathematics. I was in my late 30s.
And here comes another question that pops up in your mind. How risky is investing in stocks? I will lose my entire account. I will lose all my money. Definitely creating this Garden of Eden with a 10% per year, it's very, very difficult. Indeed, many people are losing while trying to trade the markets or buying stocks. If it was so simple, then everyone would do it, or everyone would make money in the market. However, the numbers are showing exactly the opposite. So before starting investing, make sure you have created a demo account and getting familiar with the definitions and so on. Do not invest any real money, at least in the beginning, until you get an idea. Make sure you do your research and don't trust anyone. Your friends, your uncle that claims that he lost money and so on. Yes, indeed, trading is risky. Investing is risky. Historical data, as we said, doesn't guarantee future performance. The market is a very hard arena. Companies come and goes, stocks come and goes, performances and so on. Most people have a negative idea about investing in stocks, and I don't blame them. For sure you've all heard about stories. And of course the fear that you might lose your entire account. So I will jump a little bit back and I will clarify. There is a possibility that you might lose from an investment, but what actually means that you lost? So an investment or a bad investment or loss will be if you buy something at a given price and you sell it for much less. In this case, let's say that you bought a Google share and you sell it for much less, then definitely it's a loss. And also, if you are choosing high leverage products, you might lose your entire account. I will drop another link in the description about leverage, and I do not recommend, especially if you are beginners. Each time you are searching for a share, usually there should be a code name with fewer letters. For our example, Google is called Alphabet. Okay, let's give an example. Let's say that 20th of February you decide to purchase some Google shares. In our example, 20th of February, indeed, you are purchasing a share for 77 USD. You're anticipating, you're waiting for your investment, where is your money, you want to see your account going higher, but unfortunately is not as expected. And here comes the classic mistake for all beginners. You're waiting for your account to go higher and higher. So indeed, the days are passing, however, you don't have the results as expected. The shares start losing value and you start panicking. And indeed, a couple of days later, you decided to sell. So you are selling at 52 and you almost lost 50% of your initial investment. And at this point, you are getting disappointed. You say, okay, I'm not going to invest again. I don't want to lose more money. All this investment thing is definitely not for me. But now check what happened at this point. The prices start rising and they went almost to 150 USD per share. If you were a bit more patient, you would have doubled your initial investment without mentioning the dividends. When you are investing in share, these are some long-term investments. You won't see the result in a day or in a week or in a month. It might sound long, but the period you should expect is 5 years And many people also argue that you should be at least 10 years. We are talking about the long term here. So let's check the S&P. It's pretty obvious that the prices keep going high and high. Of course, there are periods, for example, the period of COVID, that the prices drop back or goes back. But the conclusion, especially if we are talking about the long term, is that the prices will keep going higher. So, the main question here, can the market crash to zero and lose your entire money? Yes, indeed. But guys, imagine that if the entire US economy goes in zero, I mean, we are talking about a cosmic event here. We are talking about some extreme events, meteorites, the Armageddon, aliens, or I don't know what. So in this case, the last thing that you will think is your investment, because we are talking about an apocalyptic world. Probably you won't be able to have even the basics like water, electricity, or even food. So don't worry about that. This is an extreme scenario. In that doomsday scenario, money won't have any meaning. So, yes, indeed, investing can become risky, but you don't have to worry about that scenario. I mean, you don't have to worry that you will put your money and they will drop to zero. This is completely impossible. Yes, you might see them go a bit down, but again, if you have watched our video, I can guarantee that you don't have to worry so much. If you have diversified your portfolio, exactly as we explained, there is no way you could lose your entire account or your money or whatever you think. Of course, this doesn't mean that investing is not risky. Yes, you might lose, but there is always the safest way to proceed with our investments. Economy indeed moves in cycles, but if you are investing in the long term, then you will see that the stock market will keep going higher and higher. Now here comes another question, and it's very important. When you should start investing? At what age you should start? Based on our analysis and based on what we said and what we explained, the earlier you start, the better the results. Of course, there are limitations. I mean, not everyone has some money to invest and so on. Yes, I totally agree with that. But remember that keeping your money under the mattress won't bring any benefit to you. But the first rule that you have to keep in mind is that make sure you can pay your debt first. The reason is very simple, because like investment compounding, the same happens with the debt. They are also compounding. The second criteria is that you must have some emergency funds. An amount of money in case of emergency. It should be at least 3 to 6 months. For example, you might lose your job or you don't know exactly what will happen. A 3 to 6 months money to cover your living expenses considered to be ideal. The other thing that you have to keep in mind is that you don't have to invest money that you're probably gonna need in 3 to 5 years. So if you meet these 3 criteria, yes, definitely, for sure, you must start investing. It doesn't have to be something fancy in the beginning. You can do your own research. There are companies that are performing really well the past 20-50 years, so you can diversify your portfolio. The age doesn't matter so much. For sure, the fastest you start investing, the better for you. But when you are 24, 25 or close to 30, it's not so easy to start investing. I mean, you don't have the ideal job, maybe you are a beginner somewhere, so it's not so easy. Don't rush it, take your time, and if you see that you are able to invest a couple of money, then it's good. On the other hand, if you have some day-to-day needs or something that you need to cover, definitely you shouldn't go into. Okay, you have seen our entire video, you have understand these 3 criteria, and not the first thing that pops in your mind. How much money do I need to start? Actually, the answer here is very easy. You can start investing at some indexes, starting from 5, 10, 20 USD and so on. You don't have to spend hundreds or thousands of USD starting an investment. You can even start buying from a single share from 70, 100, 200 USD, and then keep compounding, diversifying your portfolio exactly as we described. You should say to yourself, okay, I can spend like 5, 10, 20 USD per month for investments. I mean, money that probably you are not going to need. Start buying some stocks, investing in some indexes, diversifying your portfolio, and you will start building your future. So if I could give an advice to myself like 5, 15, 10 years ago, I would say to start invest the soonest. Make it a habit, because probably you get at the point that you have enough money to live and you do not think about the future and what will happen. By making investment and habit compounds, and over the year you have no idea how much it will pay off. Also, some people think that it might be risky, and yes it is, but if you manage to do it with a proper way, then all this investing thing start to make sense. I will talk for myself, because indeed I was able to invest earlier, however I didn't do it. I didn't have any habits. For sure I knew that inflation was devaluating my money, but again it was not in my mindset. So the earlier you can start, I can guarantee the better for you. Some small amounts, try to make it a habit, and so on. And of course, do not expect to see results in a day or in a week or in a year. But I can guarantee that your investments will keep compounding. But everyone claims the same thing, that investing is hard, you might lose your money, and so on. However, if you do a small research and you start reading some articles about investing and so on, you might end up with the conclusion that it's not so hard to invest. You just need to find a broker and start investing. Of course, depend of the country you are, but literally it's very easy. You just open your Google and search what is the best broker, let's say for UK, Germany, or whatever country you are watching this video. Literally, it's so simple, because also they have to be regulated, and 1,000 or 1,000,000 laws to keep them regulated. You will read some reviews, and I can guarantee that you will find all the information very easy. Always try to check for the lowest fees. So you will just make your first account, they will verify you, or whatever is the regulation or what each broker has to do, and that's it. And of course the first weeks you will keep watching on your phone and see how your investment has grown. The idea is that you are going for the long term, and also you have to keep your investments for years. Maybe in the beginning you might be obsessed, checking the stock market and so on, but I can guarantee that in the long term you won't be worried about that, because you are sure that you are investing in the long term. And of course I couldn't finish with that video without saying what to avoid. Avoid all those fake 25 years old millionaires that claim that can beat the market, or they find a trick and so on. Investment is really hard. Also, you need to stay away from high leverage products, because indeed this might give you some purchase power. However, there are very negative aspects of these kind of investments. Of course, in this channel you can find all the information that you will need. But again, thank you very much guys for watching. I hope you enjoyed this video. Stay safe, and I hope I'll see you in the future.